Welcome to CoMotion Labs Fundamentals for Startups. I am your host, Patrick Chinkiewski. I am a Senior Patent Portfolio Manager at CoMotion. Fundamentals for Startups is our regular lecture series open to anyone interested in learning about entrepreneurship or building a startup. Each week we feature experts from various fields who bring you insights and inspiration and give you the opportunity to ask questions. All sessions are recorded and archived on CoMotion's website. For our full schedule and to register for future fundamentals, please visit bit.ly/CoMotionFundamentals. CoMotion Labs is a multi-industry incubator program hosting early-stage startups from both inside and outside the University of Washington community. We're committed to nurturing and enabling startup success through critical infrastructure, training, mentoring, and networking. And we do all this without taking equity or IP. We operate out of 3 locations on campus, each with its own industry focus. Life sciences and hardware incubators are both in Fluke Hall. And here, where we're coming to you over YouTube today, is the technology incubator in Startup Hall. If you are a founder looking for somewhere to thrive, we'd love to talk to you. And before I introduce today's speaker, I want to mention that for next week's event, we have Gail Giacobbe, who is a vice president of the Office Product Group at Microsoft, who will present on generative AI bootstrapping. Today, I have the pleasure of introducing Madhu Singh. She's here to present best practices for using equity as a hiring and retention tool for your startup. Madhu is a founder and managing attorney at Foundry Law Group. Her team helps early and growing companies, nonprofits, startups, and entrepreneurs build and grow their ventures. The firm provides legal strategies at all stages of incorporation, financing, growth, and eventual exits. Currently, she is president of TIE Seattle, a local nonprofit organization dedicated to inspiring and equipping entrepreneurs for success. I've had the pleasure of knowing Madhu for about 8 years now. She's convivial, she is a connector, and she's devoted and invested in the people around her. Madhu will now take questions in the live event space and via the YouTube chat. I think that's towards the end, actually, and I will now turn the event over to Madhu.
Thank you. I think I have, yeah. Thanks, Patrick. He had so much opportunity to say some crazy things as we're also family friends and our kids are the same age, so I appreciate him keeping it professional for me today. It's really exciting to be here. The last time I was in this space was the before times when it was pre-pandemic, and it's really encouraging to see this activity happening back again. I also this week did another event over in Spokane on Wednesday, and it was really energizing to even see people in that region coming together, a lot of startups and stuff like that, and beyond just sometimes I feel like we're in this bubble of Seattle where all this startup activity is here, but I feel like it's just as energizing to see some activity happening in other parts of our state as well. The reach for what we do these days in the startup world is further than it's ever been. The fact that we can do this hybrid event is I guess a silver lining from the pandemic, that there's investments in making these things more accessible. So I'm hoping to that end, making this particular presentation as useful to all of you as possible. My guess is a lot of you are startup owners. Quick show of hands, and I'll tell the audience how many you are the founder of the startup. Okay, about half the room. You are a co-founder of the startup. Another half-ish of the room, same people, or that you are working with the startup and supporting a startup. Okay, great. So a good mix of people, both on the founder, co-founder stage in the room, as well as on the side of supporting or working with a startup in some capacity or the other. Anyone still in the brainstorming stage, I might do a startup? Okay, good. Maybe. So that's also one of those things okay, I'm going to do a startup. how am I going to do this all by myself? I only have so much capital, and I need to be able to work with people. One of the things that startups usually realize that they have at the very early onset to starting their company is what they think of this as elusive equity number. Like you probably registered either on your own or with an attorney or at the guise of someone here at Startup Hall or something you saw online, the equivalent like 10 million shares. You know, everybody has 10 million shares and it sounds like such a big number. Like, what are we going to do with all these shares? And it's a little bit arbitrary because the number is so big and like, where does the real value is? Well, like on day one, is there any value to those shares? But we're not building things to have zero value. We're building things to have a lot of value and hoping to grow it from there. So on day like 365 times 4 or 5 years from there, you're hoping it's worth millions of dollars and that equity is really meaningful for someone. And so because we are oftentimes cash-strapped startups, we use this as a tool, as a way to get people energized about our idea and get people involved in our particular business and on board with what we want to do. So our presentation, I threw out a lot of different presentation ideas for today because in the field of work that we do, we cover the host of things as early as incorporation, but a lot of the kind of the growing pains that go with businesses and helping them support and grow for the future. But I appreciate this particular topic because I feel like it's asked a lot of me, but it's sometimes overlooked in terms of like when people do topics just on incorporation, because you're not really kind of looking at like, where does this go from there? Like, yes, you have 10 million shares, now what? So feel free to ask questions because I want this to be a bit of a conversation, to be as helpful to you as possible. And then we'll go from there. I did add a couple of things in here about, I'm going to talk a little bit about contractors and employees and some of those things. So if you have some questions in that area, we're going to cover a little bit of that as well. Okay, did I get this right? Okay, so at its core, we know what is equity compensation. Most of us are probably a corporation, yes or no, the people who have companies? Yeah, just about everybody who said they had a company has a corporation. In a corporation, you have what's commonly understood as shares. Shares are the other word they reference that is just what equity means. In a corporation setting, either you're going to give out some sort of restricted stock share or you're going to give out a stock option. And knowing when to use both is really interesting and how to kind of decide between the two. So at a high level, when you're giving out shares, they call them restricted shares because the shares are not freely sellable on the public market. It's a closely held company, so there are restrictions associated with it. The restrictions are just default boilerplate restrictions, but using the word restrictions is important because unlike on the stock market where you can kind of like buy and sell on your phone these days, you can't do that with startup securities. So that means you've given someone a share, they own a piece of your company, they own whatever percentage that might end up being out of the total issued shares. And then separately, there's what they call a stock option. And the word option is critical here in that it's option to purchase the share in the future. So basically, you've put on reserve. I like to think of it as like a reservation or a placeholder. Like you put on reserve X number of shares for this person who's contributing to your company that once it's vested, they can exercise their ownership stake in the company at some arguably lower preset value with those shares. To be honest, a lot of people don't use LLCs for these models in the startup world. LLCs are not the most common in the startup world, but some would argue that they should be. I'm kind of indifferent because I kind of get the value of having a shares versus saying a unit. You know, it doesn't sound as like compelling, but this is just to share with you that you can achieve the same results in an LLC construct where you can have this concept of equity, you can have this concept of options. They're just structured differently in a profits interest and an LLC unit. And so I'm not going to spend a lot of time on it. I'm just here to tell you that you can do it that way. But being in the region that we're in Startup Hall, you know, and if you're doing any sort of like kind of tech-related startup, you're going to be on the corporation structure, share structure. So the first set of people that you might hire, you might think of them as your employees, you might think of them in this particular capacity, but to truly be an employee of your company, you need to be able to pay them a W-2 salary. However, and everyone you cannot pay a W-2 salary falls into, whether it's legal or not, falls into this category of being some form of a contractor, whether it be an independent contractor, you call them a consultant, an advisor, like a what's another word, a vendor, or any of these types of terms, all those terminology kind of groups together into this contractor category, which is separate than an employee. As you can see, there's these kind of like outline some of the differences, but the biggest thing that startups often find themselves as this like pitfall as to which one is which and where do they really fall in. Like honestly, a lot of the people that are working with us side by side daily are really should be like proper employees, but you might not be in a position yet to offer them a certain level of salary. And so they arguably would be in the contractor category until you can offer them some sort of salary. All of this is to say is like, while it's not ideal, it's kind of like what we're dealt with. It's what our cards are. But these should be short-term solutions. The way to kind of get yourselves kind of beyond this is the people who you consider as close and integral to your team, they cannot be forever contractors. They need to have some sort of pathway of getting to being a salaried employee, and then in the meantime, you might give them equity as a way to highlight their contributions to the company, but at the same time, they're not really technically an employee. And the reason this matters is this is actually where people have falling outs, this is what they go to. So like you, and let's say you have 3 people on your team, and one of the people is like, you don't have any money to pay them as salary, but so you think of them like, well, they're part of your team, everybody has equity, and one person maybe is disgruntled and they're not happy with the situation. They're the person who's gonna take issue, find a lawyer, and they're gonna say, well, you treated me like an employee, I should have been an employee, you owe me back wages, you owe me double penalties, et cetera. And this is where like it becomes a big problem. And so there's lots of ways to navigate around it. But at the core of it is like putting on, as the owner's hat, being like, yes, I would really love for these to be employees, but I need to respect the fact that they can't be until I can afford to pay them employees, so I need to treat them as contractors. And ways to treat them as contractors is kind of on this side of things. Like they need to be responsible on how the work is done. They need to have their own ability to take on other jobs and set their own hours, ideally using their own equipment. If there is invoicing involved, so some people, for example, will pay for like a web design, for example, and they'll be like, will you accept equity instead of cash for this web design? And so maybe they will have some sort of arrangement, but in doing so, that you would still want to account for the fact that they accepted that equity as an exchange of payment for this process, so they can keep them in this category. On the employee side, there are some startups who choose to still play into unemployment, even though they can't offer W-2 salaries, to avoid this scenario. I don't know that a lot of people actually do it, but there are some ways to navigate it. So like getting a little advice early on, either with a tax consultant or a lawyer to help you decide how to best kind of protect yourself as a company is a really great way to kind of go about it. Did you have a question?
In this scenario of a C Corp, which is its kind of own entity, doesn't that mean that as founders, we ourselves are kind of independent contractors? We don't get a W-2. That's really big.
So the question is, like, if you were a C Corp founder, aren't you also basically contractors of the company? Effectively, yes. You're just you have this owner category that you fall into, and people who are like in that owner category, you're kind of insulated from these this kind of employment issue that I described. Those are more for people who don't fall into like the co-founder category, where you run into this risk of people who are relying on options, or they're relying on a very small percentage of equity in your company.
And is there a contractual kind of designation that sets you as a founder or a co-founder, as opposed to, we want to bring in a CMO, for example?
The question, I'm sorry, I'm repeating it for the audience. The question is if there's a designation if you are a co-founder in the categories that we're doing. The designation is that you have an officer title. And so the officer title and with the Secretary of State, whether you have a board member or you're a governing person, when you register those either here or in Delaware, depending on how you're all structured, that's kind of where you kind of put in the category that you are in this, it's not the best category, I don't know a great word for it, but in this like kind of level where you're not gonna, like if you and I were co-founders, I couldn't bring that dispute against the company that it was really an employee, because your position is like, no, you were an officer, you're an owner. You had just as much responsibility as I did with this. It's more for like, we hired my friend Patrick here to do some of our web design work that day, and he's the one who's upset about, he's the one who might have more of a claim.
Yeah, for contractors, you mentioned that you give them equity in exchange for that work. How would you think of contractors and vesting schedules, or that does not apply for contractors?
That's a great question. We're headed that way. Thanks for that segue, really. I'm going to get to that in just a moment as part of this slide. But there's two parts to that question that he's asking about vesting schedules and like vendors, and even before you get to the vesting schedule, how much to even reward the person. And so like the way to kind of think about it is, I feel like there is some going standards of what people offer for industry standards, but you should do your own research. You should talk to people in your industry. You should talk to advisors and mentors to get this kind of perspective, because you don't want to over-give someone and you don't want to under-give someone either. I'm a bit aware of the fact that I try to tell people to be really mindful about what they're giving and not give it away like candy. Like, you cannot be like, oh, I'll give you 100,000 shares or 500,000 shares. You know, like, then there's no meaning to it. And it also comes off, I feel like, a little strong. Think about yourselves in a situation. You're considering joining a startup. You're like, oh, this is a good idea. And like, before you even really get any further, they're like, will you accept equity only? You know, that might come off the wrong way in the beginning. You need to still like have some like grace with the process, but also that you shouldn't be giving it away so easily. I can't tell you the number of times as an attorney people have offered me equity in exchange for my services, and I know there are some firms out there that do that, and that's fine. But I've chosen actively not to do that. One, because I'm the proponent of not giving away equity like candy. And two, I feel like it creates an ethical dilemma for me where I am both in like could effectively be a shareholder, but then also how am I gonna advise them in a disinterested manner where like perhaps the value, or what I perceive as the value of the shares that I'm going to get, could be impacted by what I offer. But that's just my perspective, and other people have different opinions. But at the same time, like, you shouldn't be, when you're coming to me with I just need to incorporate, here's some equity. I don't know that your company has any sort of success rate yet. Like, I need to see, you need to get a little further type thing. But in the light of not giving away equities, where vesting schedules are really helpful. Investing, there should always be some form of a vesting schedule. I don't care if it's your best friend, your brother, your spouse, whatever it is, there should be some time period where you can evaluate if this is a good fit. Whether it be time-based or whether it be milestone-based, there needs to be something that allows you to make sure that this is a good fit for your company. Otherwise, you're going to run the risk of someone having even the smallest percentage ownership in your company, and they were like a terrible fit after week 2. And that will be, one, something you will have to justify and explain for your cap table for like the rest of your company. Or two, something that will always irk you every time you see that, because then you'll see even that 1% is all of a sudden worth like, let's say $100,000. And it'll drive you nuts that someone who worked with you for only 2 weeks has this part of stake of your company. So like, you just be like, even as your friend, be like, no, this is the standard. We have to do this vesting schedule. The common one that you might be most familiar with is the 4-year schedule with the 1-year cliff. 1-year cliff just means like nothing vests until 1-year anniversary of our relationship. And then because of that, we'll give you 25% bump at that point, and then incrementally you'll vest for the next 3 years in equal increments each month. There are people who will do like 3 months for like advisors, because they're like, oh, the advisor's only coming on for 1 or 2 years. They'll do like 3 months or 6 months. Cliff is is the terminology. Same structure, 25% at that point, and then incrementally other. There are some people who will do like year to year. Some people who are very milestone specific, like I just did one recently where they were like, even me as a founder, we're not gonna, and none of us are gonna trigger any equity in the company until the launch date. So, like, people have their own values and how they do that. But all of that for me is to say, you're at least putting in some parameters to make sure that these people are good fits for your company before they have any real equity in your company. If it doesn't work out, it's unvested and you could terminate that relationship. Wherever possible, I would recommend hiring with more than just equity, to the extent that you have some capital or some cash to offset it. I know some people who will offer like a couple $100 a month stipend, so that person can maybe purchase health insurance while they are doing this because they don't have other means, and they're like, we're going to raise funding in Q3, we just need to get us there type thing. And so like, to the extent you could offer something in addition, but I also realize that we're all cashed up startups, and like, that's not maybe where they feel like the best use of their money is. I do think that I think it is important to do this with vendor relationships, because vendors like they're in a slightly different position. So like maybe let's say you hired a vendor for like $50,000 worth of services. To the extent you can do like half and half, that tends to be like a better fit for that relationship, and then so on. You could kind of devise a method that makes sense for you. Did I answer your vesting question?
Yeah, that was specific about the contractors. Would you also apply the standard 1-year cliff?
Yes, so his question was about contractors, that's right, sorry, about us applying the standard 1-year cliff. And the answer is yes, everybody. Everybody who falls into this category should have some sort of cliff year period. The standard is 1 year. And because the standard has become 1 year, I don't feel like it's that negotiated that much anymore. People like, if you go to it should be just expected. If they come to me like, oh, this startup is offering me a 1-year cliff, I'm gonna say, yes, that's standard. Like, you should expect that. And this is probably the reason why, because they need to be mindful of this time. And why wouldn't you be there at least a year type thing? The only time I've seen it shorter is with advisors. People who are just gonna give in maybe a few hours a month or a few hours a quarter, those people tend to have a shorter vesting schedule of 3 to 6 months. You have a question?
Yeah, I was wondering if you knew any way to offer equity from an LLC rather than from a C Corp.
Yes, I'm not spending a lot of time on that part in this conversation, but it's effectively the same way. You have to devise your operating agreement with certain language that allows you to set up what they call a profits interest, and depending on if you're wanting to give it to more like employees, advisors, or if you're giving it to co-founders, you can divide up that. So what we usually do as an example is like, this 10 million number in the corporation world, we just defined 10 million units in a LLC and kind of followed the same structure. The language is a bit different. It's a slightly more complicated, I shouldn't say complicated, it's just a different set of documents, but it can be effectively done the exact same way. So if you have an LLC and you have these questions, don't let anyone tell you like you have to change because you can never do it this way. That's not true. You can, they just use different nomenclature.
And it's still possible to convert that from an LLC to a C Corp when that needs to be done?
Yes, that's a good point. For those of you who are LLCs or started off that way, you can do the conversion process. To me, it's much easier to do the conversion process before your LLC cap table gets too big. Like the fewer the people on it doing the conversion is much more straightforward, will be more economical in terms of legal fees to do that versus having one that's has 30 investors and all this stuff and then moving it over. So if you are an LLC, a lot of people pick that as a great way to get started because it's simple to start up and you just need some way to engage with people. I get that. And it's usually the triggering point when they go to converting to a corporation is some financing round. It's not usually like a lot of other factors. It's almost always tied to because of financing. Otherwise, the LLC structure is great and will serve you well for a very long time. Okay, is that good? Okay, sorry, I got confused if she was standing there. All right, so the question then becomes how much to reward. So when you think about the 10 million shares that we're talking about here, on average, 60 to 70% is on reserve for the founding team. So founders, co-founders, all together is about that much. There's usually, and then there's about 20 is on the high end of an equity pool, but 10 to 20% of an equity pool that's on reserve, that has its own line item on your cap table, because then you will issue options out of it in that way. So like if you have like a 10% equity pool, which is common, just for a rough number, let's say that's 1 million shares, you would then be offering people percentages out of that 1 million shares. So this is, and it kind of how much you give depends on kind of where they're at. So like I tell people if you're adding like a really key employee who's like critical, and so often those people are like the CTOs or the technical or the engineers that you really need to incentivize to be part of your team, you might offer them slightly higher. Here's some just like rough numbers you can use that we see in the market. These are not like be all end all, but this will give you some perspective as to kind of like what might be the going rate for some of these things. Again, you can also talk with advisors or similar situated companies to get some perspective, but when people ask us this is the advice we usually give them. My biggest piece of advice is really this piece on using hard shares versus percentages. Because when people say, I'll give you 1% of the company, you might be thinking, I'm giving you 1% of my option pool, which is only 10% of the company. So 1% of 10% is far different than 1% of the whole company. And so for lawyers, we really push using actual share numbers and figuring that out, or being very specific to say, you're going to get 1% out of our option pool. you're not going to get 1% of the company. And you can see how easy that is to get confused. You're just having a conversation with someone, and all of a sudden you're like, oh, I'll give you 1%, I'll give you 2%, and that's all you say. You stop there. And then it's very easy to say, like, well, in your head you thought option pool and they thought something else. So to the extent you could be as clear as possible, because when we come down to it, when we give them the documentations, there's going to be a hard number there. It's not going to say a percentage. And so there's really great tools nowadays. I'm sure many of you are familiar with Carta or CapShare or whatever the options are, and they let you run models on there. They really are, their model is like what do they call it, the freemium model, where they get us all excited because we can all access it for a while until we have to pay for it. But that time they allow you to access it is really brilliant because it gives you ways you could put in some names and numbers, or names, and you could play around and model it out for yourself better than you could have before. And then I'm so happy the days of 18,000 Excel spreadsheets doing this is gone into one visual tool. But the other thing about Carta is nice is that when you do get to the stage of needing it, you can use it as a nice way to issue options. And I feel like perception matters at that stage, and it comes off very nice to get this email, like you've been granted these options, you can sign here. It has a really good appeal to people. And perception is important because that's part of the reason we use the 10 million shares, because no one wants 5 shares. They want to hear that they have 5,000, Even if it's just in your brain, it means effectively the same thing. There's something that is driving when it's a little bit bigger, a meatier number. So, and then the last but not least, dilution is just a fact of life for all of us startups. Since we're the ones on the starting the company side, giving out options, risking our home assets, family life, everything to make this happen, somehow we are the ones who don't get to protect ourselves that much from dilution because the people with the bigger checkbooks are the ones who will try to negotiate those terms in for themselves. Some founders who are able to negotiate it in some capacity, but most of those founders are in a position to self-finance the company as well. So we do have some clients that themselves put in $1 million, and so they want to push for some of those provisions, which is different than the kind of the everyday founder that's doesn't have $1 million extra just to put into their own startup, and they'd rather work. So dilution is going to happen. And so the reason you decide on kind of an equity plan ahead of time is so that when you as founders have your shares, at least the initial say has already factored in that 10% pool, so that as you're adding more people to that pool, you're not continuing to dilute yourself each time. It's already kind of thought about in the process. So it's a bit of a planning game here as well. So hopefully this is helpful. Any questions about how much to reward? So we talked so far about statuses of different individuals in your company. We talked about a little bit kind of why you might reward it. It's not the only tool. I feel like there's more options that are out there that people don't always consider. But the equity reward in the startup world is definitely kind of the most commonly understood one. Did you have a question online?
Yes, there's a question online. How might one adjust the percentage equity for someone who's part-time? For example, a CFO who would be 1 to 5%. If full-time is only working a few hours per week.
I think you can just make use the best ratio you can. Some people look at kind of the standard salary for a full-time CFO and apply it to that ratio and try to use that as a rough number. But if they're that part-time, you can also use that as an incentive. Be like, well, while you're part-time, we're going to offer you maybe 0.25%, and then when you are able to join us full-time, we can bump up to another grant to a full percent. So to the extent you can make it a little bit of an equation, I would try to do that. But to be clear, and I think you're highlighting that point, is these numbers assume kind of a lot of involvement with the company, not fractional involvement.
Question is, and would you mind sharing a dollar value equivalent for those companies that have cash to pay with?
I don't know what the dollar value would be because it matters on the business area. Because an engineer salary is going to be far different than I think somebody mentioned a marketing manager's salary, or maybe they're the same these days. I don't know. So it's they have to take into account what the salary is, what the discounted salary would be because they are working at a startup versus maybe the Microsofts of the world. And so I will add, not that okay, you guys, I don't work for Carta. I just find it useful for startups. But they have that salary information recently added because I got this whole email about how they'll give you some of that information, which I find it helpful because my job is not to keep up to date with the salary ranges in Seattle. So I take that information, keep that to give to my clients as well because like they're giving us this free resource because they have the insider data to tell us how they're coming up with these. And they're also coming up with updated numbers of these because they have so many users now and they can offer some of that. So check some of those resources for it.
Do you use up the equity pool? Like when you give, say, 5% of the equity pool, then there's only 95% remaining, or are you like diluting the equity pool the same way you dilute the 100%? As you're giving out equity in the equity pool, you're diluting the equity pool. So like that, you would give out 5%, but you would have 95% of that pool still remaining to continue to give out. And then whatever doesn't get issued, it's at the end of the day, it's out of what's issued. Sorry, it's kind of a complicated thing. I don't have a table to show you, but let's say you gave out 1 million shares, and somebody would have, just for rough numbers, 5,000 shares in there. And you didn't issue anything else. They would have 5,000 out of the 1 million that was allocated there. That's how much they would own of that option pool. It wouldn't be 5,000 out of 5,000, which would mean that they would own all of that whole percentage of it. It's a lot of math. That's why you say use hard share numbers.
Yeah, that's why I'm like, don't say percentages, use hard share numbers, use these tools to figure out what those are, because that alone could get very confusing what that actually means for a person. But where was I going with this? Okay, yes, question.
Questions over here.
Okay, go ahead.
Once the shares vest, is there a tax implication to the recipient, whether that's an independent contractor or an advisor?
Yes, and we will. I'm going to get there in just a moment. So, did you ever, if you don't mind holding that question for a minute?
Yeah. So, similar to Carta, there's LTSC has many tools.
Yes,
What's
another good
your view on that?
Those tools are great. LTSE is also good. I know that I would say more people use Carta in my client base than LTSE, but I see people using both.
Yeah, because Carta is very expensive, LTSC is free, and looks like the tools looks pretty decent to me. So I just want to know your view.
All these things are free to a certain point. They start charging you when they want the 409A valuations and shareholders and things like that. But both tools are great. So I was just saying this because I just happen to have more clients that use Carta than LTSE. So, we talked a little bit about this already, standard for employees, asked the question about contractors. It could be on a case-by-case basis, but oftentimes they follow the same process. One thing we didn't talk about was an exercise period, which is usually after that person has left, 3 months from the time that they left, whether or not they want to exercise those options. You might give contractors a little bit longer time depending on your relationship with them. People often use this as a bargaining chip. For example, I had this one client who had a 3-month exercise period, but as part of his severance package, he wanted at least 12 months because the amount he would have to pay was closer to $100,000 to exercise it. And he felt like if he had 12 months of window as to how the company was doing, he could make that decision. So it can be a little bit of bargaining chip to offer it towards the end if you're kind of separating with someone. But the 3 months is the most common. And then the exercise price. Early stage companies, oftentimes when they give out their first options, set the exercise price themselves. But beyond that, this is where the whole 409A valuation piece comes in. And those products like LTSE and Carta, they will help you get a verified 409A valuation and set an exercise price for you. Most people in the startup world, I'm guessing in this room, are going to be in less than 10 cents, less than 5 cents a share. But something that's some monetary transaction has to take place there to exercise the options. And the last one on company repurchase rights, this is kind of an aggressive term, but something to look out for and to think about is even if you have vested shares and things like that, some companies still want to be able to control a lot of how the option pool is going, and so they build in their own repurchase right on top of everything else, that they could buy the vested shares back from you at that strike price versus at what the real value of it is. So like if you're on the receiving end of options, that might be a term to be mindful of and try to negotiate around if it's in your grant. So like this is kind of like a high level kind of piece to it, but on the securities law, that's part of what we talked about earlier, that these are not freely sellable options. So there's some restrictions to it. And these exemptions that you'll see often, 701 and other state exemptions, I don't imagine all of you spend a lot of time reading them, but they basically are designed as exemptions as a way, because they're being used as a compensation tool in this regard. And then we just talked about the 409As. And this next piece is where the question about the tax implications come in. And this is in the option world, whether or not it's an ISO versus an NSO. So the only people who can get an ISO is a real, true W-2 employee. Everyone else is going to get an NSO. So contractors, advisors. If you have people working with you overseas, NSOs are what they're going to be kind of subject to. Only kind of true employees get the benefit of an ISO. And so this is kind of like one way to kind of think about it. It's kind of a narrow way to think about it, but this is where like having a tax advisor would be helpful to kind of help you navigate this. But generally, in short, the NSOs are taxed at the time of exercise in an amount equal to the difference between the exercise price and the fair market value of the shares on the date of exercise. So the date of exercise is not the date of grant. The date of grant is like, let's say on day one, they were 5 cents a share, but on the day that they exercised it, like 4 or 5 years from now when the vesting schedule is over, they paid only 5 cents. They'll pay 5 cents a share in those 5 years, but really those are now worth $1. And so they're going to be taxed at that time as an NSO on that 95-cent spread. It's not often that huge of a spread, really, but there is some tax benefit to it. And for NSO people, they're like, well, I'm having to pay tax on something that I haven't even realized any value around. And so it can be a bit of a pain point, but that's just the logistics of it and the reality of it. For those that are ISOs, they don't necessarily have that issue. They don't really get taxed or have any real implications until they sell those shares. So like ISO, if I'm a W-2 employee, same scenario, it doesn't matter that it's worth 95 cents in 5 years. I get to pay my 5 cents a share, but when the company sells and I get some windfall from that, that's the time I'll pay taxes on the income that I receive from that. And so another reason people use options is because, setting the strike price and things like that can be like a tax advantage in some cases, especially in the ISO scenario, for people as part of their full compensation package. For people like who might be like ex-Microsoft, ex-Amazon, whatever, they've had various levels of compensation packages like this, but those are a lot more heavy duty than what we're kind of dealing with in the startup world. So I think it's helpful just if you're on the receiving end, just to spend like an hour with a tax advisor so you can plan your personal taxes over the time that you anticipate being there and when you might exercise that. It's a missed opportunity not to do that early on, so you know in your mind when the right milestones or triggers are to capitalize on the opportunity you have with the stocks that you're receiving.
Why is there a need to exercise the option? Like, I guess what drives that? Like, if it's not in the interest of the company or the employer or contractor to exercise it, why can't it just stay unexercised indefinitely?
It can stay unexercised definitely. Some people want to exercise sooner because they want to start the clock on them being shares for capital gains tax purposes. So like some people want to exercise as soon as they're vested because tax laws also keep changing. That's the other problem with advising on this, is that if you hold on, it's now considered your share, and if you hold on to it for the 5 years, you might get better treatment on it when you do eventually sell it. And then some people don't want to do that because they're like, well, that means I have to pay for it, and what if this whole thing blows up and I never have anything with it? They choose to just wait because they're like, well, if I know I'm going to get money, I'm sure I'll exercise it, But it kind of matters your personal situation and kind of what the value is. That's why I feel like the tax advisor piece is helpful, because then you'll know. So one of the things people will try to negotiate for is an early exercise. Like, if you're giving me like 100,000 option outs, can I pay for them now? Because I want my clock to start now, because in 5 years I think we'll be somewhere. And so I have seen people use that as a reward tool for their senior staff. Like, we're going to give you options, but I'll give you this benefit of early exercise for this reason. And that's how they sweeten the deal a little bit for those kind of key people. Not for everyone, but for maybe someone who's like on the hinge about whether or not joining or not, that might be something to use for it. And one more question.
Suppose we raised capital at a particular pre-money valuation. Do we still need to get a fair market valuation assessed for the share price?
Well, you heard the question. It's a bit of a tricky scenario because you don't want to get the fair market valuation too early to then impact the raise and how that's going. So it's a little bit of a conundrum, but really when you do get a 409A valuation, it's good for a year. And so like you could plan it a little bit like, oh, we got one like 3 months ago, like that has nothing to do with, to price our stocks, and that has nothing to do with this financing round. Or the financing round, you're not issuing options, people just wait. They'll allow for like blocks of time in between 409As to allow for financing them because they're not really hiring a lot or doing much with it. So it's more of a timing issue and when you do it, but you should know that once you do get a 409A, no matter how high or down your company goes, that strike price is good for a year. So when I tell people to wait to get it till they're ready to issue their first set of options, don't do it prematurely, do it tied to that time so you get a full year's time to work with. So people like also ask this question, like other ways to reward people. I feel so because at the end of the day, people are getting options. Everybody's looking for the exit, right? They just want to get the cash out of it. They don't have the same necessarily interest in the success of the company as perhaps the co-founders do. They're just different varying levels of interest. So I do feel like there's an opportunity to also consider alternatives if you feel like equity or option pools are maybe not, or maybe your company is far along advanced that if you did do options and got a 409A, the strike price would be very high and it would be really difficult to kind of have that conversation and negotiate with them. And then you're like, okay, what else can I do? Well, I have had companies they're all kind of somewhat similar, but they're like, it's a bonus plan, a revenue share plan. Like if we sell the company, you'll get a percentage of it. Sometimes they're called phantom stock plans. I don't like the word phantom stock plan. It makes it sound like it's sketchy. But if you were to Google it, you'll find these things. But basically, it's effectively effectively treated like a stock plan, but it's not a real equity. It's just a plan, like much like any sort of like sales compensation commission plan you might put together for your team. It's very similar to that. And so like you do the same thing, like, oh, there's 1 million shares in this plan and we're going to give out these shares and these are the terms for it. But those have been very successful. I have several clients that are like either single owners or 2 owners. They wanted to keep their cap table clean. They took no investment. They bootstrapped the company, but they wanted a way to reward their senior staff, and they opted to do this instead of a stock option plan because they wanted everybody to see what they had, like pieces in it, and then because they were going to sell the company, they put the proceeds in it and divided it up, and everybody got their piece of it. They at that point they were too far along to benefit from any capital gains treatment or anything anyways, and so like this was kind of a simpler solution for them to offer something of value to reward their team without just only relying on options. So I feel like it's at the earliest stage, option plans are probably the most likely scenario because they're generally still affordable. They're still at a few cents a share, or even par value or 0.0001 if you're that early on. But at some point, the strike prices and everything starts weighing on you and gets higher. And if you haven't set up an option plan yet and you're in year 5 and you're like, okay, I'd like to do one now, you might consider some other options. There's also the stock appreciation plans where people they'll get a valuation done and be like, this is the value of the company today. The value of the company today is $10 million. And then we're going to give you shares in the company based on this valuation, and anything that appreciates from here, you get that percentage, you get the value between the differential there. So there's also plans like that. These types of options generally come up when the company is now in the $5-10 million range and is looking for ways to incentivize their senior staff to stay with them. Because we're in an interesting market here in Seattle where there's a lot of competition and like higher salaries in some places versus others. And so they've come up with newer ways to think about different methods to reward people and incentivize people. But as a founder, I feel like it's hard because you're like, you have so much invested in this, and you have to think so much about how to get other people on your vision. And so like getting people on your vision is step one, convince to be part of your team. And step two is like you want to make it meaningful for them. And some of these tools are ways for them to have a little skin in the game too. Because you hope if they have a little skin in the game, they'll put in a little extra effort to help you get to that successful point you're looking for. And I also know that this is maybe the only way you have to attract people at the early stages when you don't have maybe the biggest budget that you would like to when you start your company. My last piece of advice here is like, the bigger problem is that people just make a lot of promises, they write it down in an offer letter, but they don't do any of the paperwork. Thank you. They don't do any of the paperwork. And so if you want to hold off on the paperwork for budget reasons, I get it, but don't hold off indefinitely. It'll eventually bite you at some point if this is not available. I know there's resources at places like Startup Hall and other places in the Seattle community where you can get access to some of this information or these things. You know, I know there's tools out there. Like I realize I'm a lawyer and I do this type of work, but I'm very aware of the fact that there's tools out there like Clerky or Stripe Atlas or what are some, Gusto, whatever they are called, that are they're trying to create like a proper legal set of documents for startups, and that's totally fine. But you can, if you're using those, that's fine. I'm not saying don't use them. They're all like good products, but it might be worth getting some tax and legal advice to decide how you want to structure the whole thing. Because the worst is going back to someone and be like, I meant to give you X shares. I need you to forfeit some of them. What's going to incentivize them to forfeit some of them? You know, or you have to devise a plan to somehow like dilute them so you can get them what they really wanted. So like you don't want to be in those situations. So like kind of being mindful about how you do this. And so like people, this is just kind of like what is generally needed, the common term language that people use for this type of thing. But I do know that like even today, this client has offered equity for the last 3 years and has had a plan, documents ready to go, but has not signed any of them. So I can't do anything. I can't, like, we kind of are now backtracking because 3 years ago she didn't sign them. She just held on to them all this time. And so now we're having to, because you can't backtrack the date you give somebody something, but you can backdate their vesting schedule so we can work with it and you can adjust it. The less you have to adjust, the less you have to explain later when you're doing diligence in a financing round. All this is is like, it can be adjusted. I'm not saying don't be afraid of any of this. You can fix things. But the thing that I find that founders hate most is in those diligence conversations or explaining why they had to fix things. And like, what do I say? Like, she's going to just say, I forgot. And it's fine. It is what it is. People, like investors know that this is what happens. But it's one less conversation you'll have to deal with. So I have about 10 more minutes, I believe, for questions. This is the vast majority my presentation, or it is. Thank you. Feel free, if you have any questions or follow-ups on there, feel free to email me. We're always doing programming and stuff like this here in the community, and we have try to keep up a decent blog covering a lot of these topics as well. So I appreciate the time. There's a question online.
So a question from YouTube, from Jonathan. Could a founder decide to treat their contractors better by extending the amount of time someone has to exercise the NSO or tie it to a milestone such as a liquidity event?
So the question, that's a really interesting question. I guess you could do that for a contractor. You could give them a longer period of time. You should offer that when you feel like the services of that contractor are worthwhile, like towards the end of that type of relationship. So for example, let's say you hired a designer and they did a great job for you and you gave them the equity, but they don't have the money to exercise it. First they did a great job for you. Then you can think about using that as a way to improve the relationship by giving them a longer period to exercise those options and maybe tie it to a liquidity event. I wouldn't do it too early until you've seen the work product. Another question?
I have another question from Ryan. For a CEO recruited at an early stage to be able to raise a first round, how much would they typically get, such as an early stage university startup?
How much was that's a hard one because the CEO, it's going to be tied a little bit to what they think the valuation of the company is then. and then they would work backwards to figure out a percentage. But it's probably going to be in that, like, the range that was on here, which now I'm forgetting what I had. Like a 1 to 5%, probably on the higher end of that if they're the CEO contributing to that. They might negotiate for a little higher than that, but I haven't seen anyone top 10% in my like 13 years of doing this. And those people that did get it were very senior, experienced folks that were going to really help them get that raise. Yes.
So going back to that slide that you had, those numbers like 1 to 5% for C-suite, that's out of the total shares of the company, not of the equity pool?
It depends. Like, so this slide contemplates out of the equity pool, not the company. And so what I've seen people do is like the founding team is on the restricted share piece. Perhaps the CEO in this scenario might say, I don't want options, I want shares. So you might factor that in and be like, okay, we'll give them 5% of the company versus 5% of the option pool. But you can do the math to figure out the rough equivalence of the two. I wouldn't, aside for key people to the organization, no one else should have restricted shares. Like, you can kind of think about in that example that they gave earlier that maybe we could give them restricted shares instead of options. But at some point, that won't even be feasible. So in the example we just heard, if the CEO was coming in year 3, for example, it would probably only be options. But if they're coming in the first 3 months, you might have restricted shares still available to give them. Okay.
I have a question from
Yep.
YouTube.
Uh-huh.
What can be done to mitigate early employees or founders who leave the company but still have a lot of shares?
So the mitigation strategy of leaving the company and still have a lot of shares is really the vesting schedules and trying to negotiate a decent amount of time for those. The other thing is that repurchase right is like and to be honest, I feel like the repurchase right is aggressive for the founding team. It might be more on reserve for someone else, but that's part of the risk that goes into this. Like, if you're going to have a co-founder, you got that co-founder because you agreed on some number of shares. But if they left after like year 2 and they got a good decent amount of shares, there's only so much you can do at that point. And you would hope you'd figure out that relationship in the first year. So just be mindful of that for that reason. That's why some people like co-founders go on the same vesting schedule intentionally. There isn't anyone who's not on a vesting schedule in a company because the expectation is that everyone has skin in the game, everyone's committed. We all know that investors want to see it too, that a founder is also waiting to receive the full value of their shares. There are some founding teams that'll do 50-50. They'll do like 50% vested and 50% on a vesting schedule to kind of show the same thing. But again, those would be one of those kind of case-by-case things that we would evaluate with people. In that example of 50-50, the reason we did that in one of my clients' scenario is because the 2 people had been working on this project for a very long time and had already gotten a patent and everything. So they were starting the company at a different set of assets than they would before. And to reward themselves for already getting that asset, they took a 50-50 schedule. So like there's some things you can think about, and it's really case by case at that point. Do you have a question over here? Oh, hold on. Sorry, he is the mic. Go ahead.
So it's like for a company that's still at the LLC stage, a lot of times it's driving conversion to a C Corp is raising money to make hires. Have you seen any companies that were LLCs like creating an option pool and staying in LLC longer and using the option pool and maybe lower pay to remain in LLC longer and put off fundraising to like avoid dilution? And then like when that conversion from LLC to C Corp happens, it's not like a whole bunch of different shares. It's just you'd carry the equity pool over to the C Corp.
Yeah. Yes. For that matter, I think even like, I want to say like Rad Power Bikes is still an LLC. I use that as an example for how big they are and how many types of investors they have. And it's all done in that construct because you can set it up that way. And I think the LLC is a really great way for people to work because I like the profits interest model because I feel like it truly rewards people for when they come into the company versus like everybody kind of playing in the same card. It's just like we live in this like this kind of more commonly understood corporation structure. So I think if you ended up devising the plan that you have in mind with your LLC, you'll be fine for quite a while. And at the point of converting it, it should just be like just straight paperwork to move it over. It shouldn't be like, oh, now we have to do a stock split and recapitalize this, and we should do this. If you, in your mind, thoughtfully know that that might happen in the future, they can, your counsel or whomever can devise your LLC really well that way. My business partner, who's our securities attorney in our team, he does a lot of those, and he loves LLC. He's like uniquely poised to advise on that because he feels like it's a missed opportunity for some startups to really benefit from that structure. So it can be done. That's what all that to say.
Yeah, thank you. So 48 months typically was a standard, and that's what everywhere the vesting schedule is. But it's turning out to be obsolete given even the companies are private for a very long time. So are you seeing something in the market where you can see vesting more than 48, or 48 is the standard?
48 is user standard. The highest, like some people do a 5-year schedule. Some people re-up their schedule. So like after they've been there for 4 years, they might give a new, they call them refresh grants. Like you might give an extra 5,000 shares or extra 10,000 shares, and those trigger a new 4-year schedule. And so like that's how you kind of like continue the incentive piece of it, is new grants. I think there was one more question over here. She had one, yeah.
At what point of the startup journey would you recommend to start this whole equity and compensation structure that you're recommending?
I think that's a really great question, because I don't really think it needs to necessarily be done on day one. I think it's like as you are working on your startup and you are realizing that you need more people to help you, and if those people are like, well, what am I going? Are you going to give me anything in exchange for that? Or you're at a point where you're like, I'd like to reward them for what they're contributing. That's the time to do it. Some people, that's a year or two after. Some people, it's in the first year. There are some people who come maybe even later than that. And then some people, they get forced to set it up at the time of financing because they are receiving financing to then hire those people to then give them these options. And so the investor wants the pool to exist before they put the money in. So there are like, that's a more of like defined trigger point. But for you, I think like it's okay to make sure you're all a good fit. You could tell your team that like, we need some time to make sure we're all working together. We need some time to pilot this project. And if things are going well, we will get the paperwork in place to issue these equity grants at this time. You know, like use it as part of your value proposition at that point. I think we have only a couple of minutes left and maybe one more question.
We have a question.
Are there any special considerations that need to be made for people joining the team early who are on F1 or H1B visas?
That's a good question. That's a little bit kind of outside of my scope because I don't do a lot of immigration work. But what I do know is most often there's just like some thought has to put into whether or not they can receive that equity. Most often they can. I just think they cannot be, the H1 might have more restrictions to it because that would assume that they're still working somewhere else on an H-1B visa and maybe supporting you on the side. And so assuming they're in compliance with their visa things, then you could do that. So I think that's worth a conversation with with an immigration specialist to make sure you're not violating, or those people making sure that they're not violating the visa they're on. On the company side, it's a little tricky because you're just like, that's your visa, you need to figure that out. Until the company can then honor the H-1B transfer or the F1 transfer, or whatever it might be. But something to look into.
That is all the time we have. Let's say thank you to Madhu.
Thank you. Really great questions. Thanks, everybody.
Thanks to all of you who came to Startup Hall today, and those of you who tuned in on YouTube. Please go sign up to attend next week's talk for Fundamentals for Startups. That will be Gail Giacobbe talking about generative AI bootstrapping. Thanks again. Take care.